pointed to gains in jobs and a lower unemployment rate as reasons to stop quantitative easing. That program saw 3 phases over the past 6 years. In all, the Fed spent nearly $4.5 trillion on bonds. That new money helps stimulate the economy.
All right, a slice of economic history of sorts. This week, as the Federal Reserve ended the program known as the taper, quantitative easing, QE, that thing. Call it what you will, but now comes the next step, deciding if this was indeed the right move and what happens next from the overlords who rule our financial lives. So let us welcome back to MidPoint, veteran economist, I should say. See, it was not enough. I didn't have enough money. People didn't pay me enough for the false teeth. Economist and chairman of the Society to Advance Financial Education, Steve Beaman, joins us. Steve, good to see you again.
Well, it's good to be on with you again. I'm so pleased to do this for your audience.
Always a pleasure, my friend. Now, is this really, when I say historic of sorts, isn't it fair that we do put it in that sort of a context?
Yes, I think this was a real historical chance for the Fed to try to do something right. They don't have a really great track record, but Bernanke, being such a student of the Depression, looked at 2009 and said, if I don't provide liquidity, this entire thing could crash. So this was an effort on the part of the Fed to put liquidity into the markets, therefore supporting the stock values, the wealth indexes, and hopefully keep the economy going while things could be worked out.
What changes will the consumer see at this point? I realize it takes time for everything to trickle down, but where is this leading?
Well, there you go with that phrase, trickle down.
Sorry about that. I didn't mean to go ahead and say 2 dirty words in economics, but I thought I'd try anyway.
Well, there you go. But the reality is folks should be watching interest rates right now. As the Fed begins to taper back and quit buying new bonds, it's still said it's going to hold a zero interest rate policy, or ZIRP policy for a cute acronym. But we want to watch 10 and 20-year interest rates to make sure those don't start moving against us. People who want to buy homes ought to be looking today to probably get into those mortgages sooner than later. You've got Freddie Mac, who started to see some hints at an interest rate increase. And I think as we approach the spring of the year, you could see the Fed stop its zero interest rate policy, and that will most definitely lead to an interest rate spike.
All right, now when they stop that zero interest rate, what are we going to look for that we as consumers and those on the outside looking in will be able to say, there's the trigger, and that's likely going to mean that interest rates go up?
Well, the Federal Reserve Board of Governors has said they're going to keep the zero interest rate policy in place at least through the summer of 2015. But I think if we see a strong third quarter, and all indications are we'll come in around 3%, if the fourth quarter holds strong and the first, you could start to see interest rates move at that point in kind of a forward forecast of the Fed moving on that interest rate policy in the summer.
So it's that first quarter of 2015 that we have to look for and see what those numbers are, right?
I think so, because right now the third quarter is going to come down off the second. We all expect that. That's not a surprise. And with gas prices down this nice piece they've been down, we could see the fourth quarter supported through the Christmas season. And so really the first quarter is going to be the make or break.
They were buying, the Fed that is, $15 billion of monthly bonds. So what happens now that there is no longer that bond purchase being made? Where does that all shake out?
Well, they're betting that the consumer market, the institutional market, and the global markets will still support the United States Treasury by buying those bonds. And the reality is they probably will. There really is nowhere else to go with your money today if you're looking for purely safe money. So the ability to sell those Treasury bonds in order to raise money to fund the government looks pretty good right now. And I think that's one of the factors that led them to this conclusion.
More accessible than bonds, different types of bonds. How does it all shake out here for the public?
Well, I think for the public at large, you've got 2 real different groups. You have retirees who are looking for interest rates to go up and waiting for that so they get some return on their capital. And then you've got the other side looking to borrow money to buy homes, and this benefits them. But I think right now, folks just need to be cautious. If you're looking to borrow money, now's a good time to do it. If you're an investor and you're looking to get return on your money, you definitely don't want to be buying long-term bonds right now.
About 30 seconds left here. This is one of the longest bull markets in American history, and it is thanked in many ways to the bond buying campaign here. So is the market now basically being said, you're self-sufficient and on your own, guys?
To a large extent. I mean, you saw the markets react pretty positively today. We're back into 17,000 territory on the Dow. And as long as the economy keeps moving in the right direction, you'll see the markets responding nicely.
Steve Beaman from the Society to Advance Financial Education, which we do every time he is on the show. Steve, always a pleasure, my friend. Talk to you again soon.
Thank you very much.
All right, take care. Short break, and back with a peek into the New Hampshire running duel between Scott Brown and Gene Sheehan. And at 51 minutes after the hour, News Call gets to slap a proper definition on what is a real sports dynasty. One of the most overused words in sports, right next to great. But I think one baseball team proved to us that, at least in a 5-year span, dynasty fits. MidPoint will continue.